This is Matthew Cratter from Bitcoin University, and today I want to answer the question, is BlackRock shorting Bitcoin? But first, some important background. It's important to understand that BlackRock is fundamentally a profit-driven enterprise. They may bring in various ideologies like ESG, for example, in the pursuit of profits, but then they're quite quick to dump their support for those ideologies when they're no longer a golden goose. And this is the progression we saw from 2020 when BlackRock was all in on ESG to 2023 when they began to pull back and saying they were ashamed to be part of ESG. And what I argue in this video, which I'll link to in the description notes below, is that was really the preparation for the Bitcoin spot ETF that changed their approach to ESG. Now, BlackRock's incentives for their spot Bitcoin ETF is basically just one thing. They want to increase the assets under management, increase the AUM through in two ways, really having more people buy their Bitcoin ETF and then having the price of Bitcoin pump as well. This is where the incentives are, and these two combine to create a virtuous circle where when Bitcoin's price pumps and people talk about it, then more people are driven to Bitcoin. They hear about the Bitcoin ETF from BlackRock and they buy it. This causes the price of the ETF and Bitcoin itself to pump more because there's this arbitrage across spot, across futures, across the ETFs, as we've spoken about over the past few days. And then as Bitcoin pumps more, it draws in more buyers of the Bitcoin ETF. So that's the virtuous circle. Now, why does BlackRock want to increase its AUM? Simply because BlackRock gets paid 0.25% of the AUM for the Bitcoin spot ETF. So they're basically in it for the gains. And I think this is always one of the better ways of understanding how the world works, is to follow the incentives of various groups and to see what they do and then to understand their incentives for why they do it. And BlackRock is incentivized to have Bitcoin pump. This is very important to understand. They're not incentivized to short Bitcoin or issue ETF shares that are not fully backed by real BTC, because doing either of those things could suppress Bitcoin's price and thus would be bad for BlackRock's profits as a publicly traded company. And one side note here while we're at it, it's important to understand that really anyone can join the BlackRock club and profit from their quote-unquote nefarious insider schemes just by buying some shares of their stock, which the ticker is BLK. So this isn't completely a closed club. So what's this then? This is a very important chart that's been circulated. I think it was started by Zero Hedge. Big jump and new record high in Bitcoin hedge fund net shorts. When this snaps, it will make Volkswagen, GME, GameStop look like amateur hour. And what this is a report from what's called the Commitment of Traders, the COT. This is a weekly market report that the CFT puts out in which it discloses based on a poll which participants are holding futures, both long and short. And the traditional way this is done is you really have three groups. You have the commercial traders, and then you have the non-commercial traders. Non-commercial traders are often known as the large speculators. And then you have the non-reportable group, which is much smaller. And these are small speculators. These are the little guys, the dentists and doctors playing around with their futures accounts. At least traditionally, that's how it's understood. The commercial traders, for example, would be the ones who actually, when it comes to physical commodities, these would be the farmers who are hedging their production of farm. These would be the actual producers of the commodities. The non-commercial traders would be the speculators, the large speculators, and the hedge funds. So that Zero Hedge chart is based on the Bitcoin futures, which trade on the CME. They say they trade on the Merc. And we can see here how futures work. You have various expiration months starting from June 2024 going out to, call it, October 2024. We can see that the volume and the open interest really drop off. So this is really a front month game, or the front 2 months. And then we have various settlement prices. This is a snapshot as of last Friday. And we can see that the prices are upward sloping. This is called contango in the futures markets. And so the price for settlement of July 2024 futures is higher than the price of June. The price of August is higher than the price of July. And what futures are, they're really just an obligation to deliver a certain commodity or a certain asset by a certain date. And what happens as these futures move closer to maturity, the prices move down and converge to the spot price, because that's where they will eventually be settled. This is the raw data for that zero hedge chart. This is from Trading Stir, but we can see here, these are basically the commercial traders. This is a little different because Bitcoin is a currency, or it's a digital commodity. It's not a physical commodity, so you don't really have producers of it in the same way you have producers of corn. You do have the miners, but it's a very different thing here. The asset managers here are essentially the commercials. The leveraged funds are the large speculators or the hedge funds, and then the non-reportable positions are the small speculators. But what zero hedge is really looking at here is this large short, and what they do is they net it out. You take the position here, the shorts, and then you subtract the longs from it to get an idea of the net position that the large speculators, which are the hedge funds, are taking. And it's important to note that it's not BlackRock that is short these futures in size. It is hedge funds. It's large speculators, not asset management companies. There may be hedge funds inside of BlackRock that are doing a little bit of this, but this is basically a large speculator hedge fund position. And here's what they're actually doing. They're doing something called the cash and carry trade or the basis trade. These are two names essentially for the same thing. What you do in this trade, and I do not recommend anyone does this, it's kind of a waste of time, but what you do is you buy the underlying asset, in this case probably the spot Bitcoin ETF, though you could also use spot Bitcoin, and then you short an equal amount of futures against it. And this is why the large speculators, why the hedge funds are short so many futures contracts. Now the CME contract, it's the size of it is basically 5 Bitcoin. That's how many need to be delivered. And so the way you would put this trade on is you would buy 5 Bitcoin at spot, call it 69,755. I believe that's where things settled out on last Friday, and then you short one futures contract against it. And as we saw, the futures prices are in contango, so you'll be selling this futures contract at a higher price than you buy the spot Bitcoin. In principle, they're going to be using the spot Bitcoin ETF here because of storage and delivery reasons. But for now, I'm just going to pretend that they're buying 5 Bitcoin. And so we have the total here. We're basically buying $348,000 worth of something. We're selling $351,000 worth of something. And it's important to know that this is a hedge position. So you're long the Bitcoin, you're short futures against it. So you're pretty much hedged. If the price of BTC goes up, you make money on your spot Bitcoin position, and then you lose money on your short futures position. If the price of Bitcoin goes down, you lose money on your spot Bitcoin position, and you make money on your short futures position. Now, as the July futures expiration date approaches, and it's almost always the third, I believe it's the third Friday of every month, as this date approaches, the price of the futures contract, the July futures contract, will converge with the spot price, and they'll be the same at settlement and delivery at the end. And so what happens if you're long BTC and then short the futures against it, in this case, you'll get to pocket that difference if you're able to hold all the way to the closing of this trade. And that would be about $2,900 here. That's about 0.83% in just 6 weeks, or about 7% annualized, which is much higher than you can get using risk-free things, quote unquote, risk-free things like treasuries, in other words, the risk-free rate. These returns can be juiced as well using some leverage. You could borrow money to buy the spot Bitcoin ETF. You could get at least 50% leverage and probably more as a hedge fund from your prime broker. And then the Bitcoin futures come with their own leverage, which is not that great compared to other futures. You have to put up quite a bit of margin. Now, this only works over time if the futures curve remains in contango with the prices upward sloping, as we saw. And there are risks like the spread temporarily blowing out or the basis blowing out. But all in all, it's pretty easy money. But I don't think it's not a great trade because the margin requirements are so high, as I said, for Bitcoin futures compared to traditional commodity futures like wheat and corn and oil and gold. In practice, I think that most hedge funds will use the spot Bitcoin ETFs for the cash side of this trade rather than buying real BTC due to the complexities of custodying the latter. And so that's basically the trade. You buy the spot, or you buy the spot ETF, you short the futures, and you make profits. So at this point, you might be asking, why don't these hedge funds just go long BTC or the spot ETF instead? Why put on this hedged position? Well, one reason is they are called hedge funds, and they're supposed to do fancy things. This is what they're paid to do. And they also charge these very high fees, traditionally 2% management fee and 20% of profits. This is called 2 and 20. And they need to earn these fees by doing fancy things. So you don't pay a hedge fund manager just to go long BTC. You can just do that at Coinbase or something. Or you don't pay a hedge fund manager to buy the Bitcoin spot ETF, which you can do through your brokerage account. and you can do all of this without paying that 2 and 20. So this is, if you're a hedge fund manager, you have to put on complicated trades to look impressive. But really, it's important to understand that these hedges are just fiat maxis or profit maxis. And I should know, because I actually used to be one of them, they don't believe in Bitcoin and they don't understand it at a deep level. They just want to capture the synthetic yield that comes from the cash and carry trade. They want to collect their management fees and their profits, their 2 and 20, and then head to the Hamptons. Cash and carry is a trade that's been around forever and has been applied to commodities like gold and oil, but there's a fatter spread to be earned in new markets like Bitcoin. So that massive future short is almost certainly being offset by a large long position in the spot Bitcoin ETFs. And going long BTC or going long the ETF and shorting the futures against it has a zero net effect on Bitcoin's price, because you're going long the same thing essentially and short the same thing at the same time. So what Zero Hedge has done here is basically useless clickbait. Now, when it comes time to unwind this trade, when the hedge funds unwind this trade, what they're going to do is they'll sell the spot Bitcoin ETF. And in practice, this unwinding and winding is happening all the time across different funds. But in aggregate, when it's time to unwind this trade, what you do is you sell the spot Bitcoin ETF, or you sell the BTC that you have, and then you buy back the futures. You buy to cover the Bitcoin futures to zero out your exposure in the futures market. And presumably you'll do this at the same time so that you don't lose anything on either side and you're able to maintain your spread position. So you simultaneously close both legs of the trade. So even the unwinding of this trade should not have any net effect on Bitcoin's price, due to this arbitrage we've spoken about over the past few days across spot Bitcoin ETFs, across real BTC, and across BTC futures. And then there's a global arbitrage that goes on across OTC desks, across exchanges, basically one price, one global price of Bitcoin that everything converges to. There will be regional differences, but there are these arbitrage opportunities that basically keep all these different instruments in line. Otherwise, there'd be a risk-free profit to be made. Now, the current short futures position is approximately 18,175 contracts. I believe I got that right here, 18,175. And each contract covers 5 Bitcoin. So this is the equivalent, this future short position is the equivalent of 18,175 times 5, or 90,875 Bitcoin short. That's the size of the short measured in Bitcoin. This was an interesting table posted by Michael Saylor, which shows the growth in the holdings of the Bitcoin ETF. So we have all the US ETFs up here, Bitcoin ETFs, we have all the global ETFs, and this table begins on January 10th when the SEC first approved the Bitcoin ETFs. At that point, Grayscale was really the only game in town with 619,000 Bitcoin. And then this goes all the way up to last Friday, to June 7th, 2024. And we can see the amount of Bitcoin held by these ETFs. It was originally held in the Grayscale Trust, which was converted to an ETF. So at the beginning of this process, right on the day when the SEC approved the Bitcoin spot ETFs, these ETFs in aggregate across the world, not just the US ETFs, were holding 752,160 Bitcoin. And as of last Friday, they're now holding over 1 million Bitcoin. So spot Bitcoin ETFs have still been accumulating a lot of Bitcoin on net that is not part of this cash and carry trade. And we can calculate that by taking the ending amount of Bitcoin in all these ETFs from Saylor's table there, subtracting where it began at 752,000. I believe those numbers are correct. Yeah, 752,000 held on January 10th of 2024. And then we're going to subtract out the future short, the equivalent amount of Bitcoin for the future short, which we calculated right here by multiplying the number of contracts short times 5 Bitcoin per contract. That leaves us with 188,938 Bitcoin accumulated by the spot Bitcoin ETFs since the launch of the US ETFs. And this is the number of Bitcoin approximately, presumably, that's not part of this cash and carry trade, because we just netted that out. This is the aggregate growth that has not been not part of the cash and carry trade. So again, the SEC approved these ETFs for the US on January 10th. They started trading on January 11th. That's when BlackRock's spot ETF was launched. The price of Bitcoin on that day of the SEC approval, the closing price was 46,666.11. And then last Friday's closing price on June 7th was 69,324. And so that's basically a 49% pump over 149 days. And I would say that's not too shabby for a $1 trillion asset with only 188,000 coins bought by the ETFs, not counting this price neutral cash and carry trade, which of course does not affect the price. So that's like, to put this in perspective, 49% returns. That's like 5 years of typical S&P 500 stock market returns, all rolled up into a mere 149 days. And you've earned those returns holding the most sound money in history while it's sitting safely in cold storage. You don't have to trade it. You don't have to hold it on an exchange where it can be hacked or lost. So I hope this analysis puts to rest some of the concerns around why Bitcoin's price is quote unquote not pumping enough. This is a fairly significant pump, and there have only been a certain number of coins accumulated on net by the spot Bitcoin ETFs, apart from the cash and carry trade, which is neutral to price. Here's the math that really matters in the long term for Bitcoin's price. You have infinite fiat and you have only 21 million real Bitcoin. This is the big picture, and this is why Bitcoin will indeed pump forever. If you own fiat money, if you own paper Bitcoin, if you own spot Bitcoin ETFs or Bitcoin futures, instead of real BTC that you custody yourself in cold storage, you're simply not going to make it. And anyone who does the opposite, anyone who does a naked short of BTC or owns or issues instruments that are not fully backed by BTC, will eventually get taken out in a body bag, just like they did at FTX and BlockFi when they tried to produce paper Bitcoin. They got called on it and they didn't have the Bitcoin when people wanted it. I want to close with a quick note about Bitcoin University channel memberships, which I rolled out late last week, and I'll link to the video in the description notes below. A lot of people have been complaining that the join button does not appear for them, especially on the iOS or other YouTube apps. And you can see, for example, here on my channel, even if you click the subscribe button, which is what you have to do first, you still won't see the join button. And so I want to show people right now, if you're interested in joining, how you can do that. You can either do it from an individual video on laptop or desktop. You can just click join right here. Then there are two different tiers: Humble Bitcoin Pleb and Toxic Bitcoin Maxi. That's one way to do it. You can also do it from the homepage of the channel. You can click the join button right here. I'll also put a link in the description notes below this video, as well as in a pinned comment. This link is basically the URL for the channel's homepage, followed by /join. So I appreciate all of your support. And again, the primary reason I've been rolling these out is not just to make some additional income, but also to incentivize YouTube to spread the message of this channel and share the videos more widely. Subscriber growth has been quite sluggish, even though we've been in a pretty strong bull market for the past year and a half. So really appreciate your support if you're interested in doing that. If you enjoyed this video, be sure to hit the subscribe and like buttons. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.